As the OPEC delegates arrive in Vienna to discuss the group's production strategy, the price of oil has had its worst four-day spell in a month, despite ending the month of May with its fourth monthly gain in a row. Malcolm Graham-Wood joins us now. He's the founder of HydroCarbon Capital and the author of malkysblog.com. Malcolm, what is the market pricing in from OPEC when it makes its decision on Thursday?
Well, I don't think the market is expecting very much. I certainly don't think the market is expecting a deal that would cap production or anything to increase prices. The main reason for that is, as I remember saying to you a little while ago, is that OPEC really doesn't exist in the form that it was set up way back in 1960. The smaller members of the OPEC group, are and given that Venezuela was a starter member but is now a smaller member, and those countries are not capable of making any of the decisions. So, to be honest, it's what's going to happen between the big five, I guess. And as far as that's concerned, the key thing is that there's this incredible problem that continues between Saudi Arabia and Iran, and nothing is going to change that at the meeting tomorrow.
So why have prices risen so much over the last 4 or 5 months?
Prices have actually risen dramatically recently because of a number of outages from big producers. Obviously, Canada is the one that comes to mind because of the fires. Canada provides, supplies 3.5 million barrels a day, and almost all of that was off at one stage. So you got at least 1 million to 2 million barrels a day off the market from Canada. You'll understand that Nigeria, with the terrorist activity, is down to sort of all-time lows. And of course, as you know, there are problems in Venezuela where they've got problems with the economy, and they aren't getting oil out, as well as various other places. There's been outages from Brazil and obviously Libya, which is in the process of further terrorist activity in the areas around the ports. So, whereas I've been saying for some time, and correctly at the moment, is that there's a lot of oil around, storage is very high, but the oil industry and the oil producers have been sort of bailed out by the short-term outages, creating a bit of a push up to sort of effectively $50 oil.
So here we are, halfway through the year. How do things look for the second half of 2016 in terms of the price of oil?
I think the outlook is beginning to look quite interesting, and certainly quite interesting on the upside. I think for this year, I'm on $50 for the end of the year, and I've been fine-tuning that up a little bit as we've had as the year has gone by. I'm not inclined to change that dramatically at the moment, but next year could be higher. I've got $60 in for the average for the year next year. But I think the interesting thing will be is that this price could spike upwards when the market realizes that we've got we're back into equilibrium on supply and demand, and there isn't so much to be brought back on in a hurry. I mean, things can come back. So some U.S. shale will come back, and various other people will be brought in if the oil price does look like being 60 rather than 50. So I'm not getting carried away, but I do think that by the end of the year, the market should be working on a $50 price and potentially a bit higher, potentially quite a lot higher for next year.
Okay, Malcolm, thanks so much indeed. That's Malcolm Graham-Wood there from HydroCarbon Capital.